Morning, market chameleons, and my favorite chameleon, Dimitri Pargamonic. How you doing this morning, D?
Good morning, Will. How are you?
Awesome. Let's get started with the disclaimer. What do you think?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors or broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions, provide you with guidance. There's the disclaimer.
Excellent. What are you seeing this morning?
Let's take a look. I'm going to share my screen. So I think what we'll do is start out taking a look at the pre-market movers. Then we'll move on to earnings, since we've already had some earnings coming out. We have a bunch that are still supposed to report. So we'll take a look at some earnings reports actually that I don't usually cover or haven't in a long time. So I'll do that today. Let's start with the pre-market report. We got stocks that are most active, trading in the pre-market hours, biggest percentage gainers, biggest percentage decliners. I'm going to take a look at what's going on in the higher market cap stocks. I'm using this filter market cap, going market cap over 20 billion. So we see we got 21 on the percent that made our percentage gainers list, 14 on the percentage decliners list. So from that perspective, it looks kind of like a neutral to a slightly bullish bias at the open. A bunch of them here, I'm just noticing, have been reporting earnings. TAL reacting to an earnings. Blackstone BX reacting to earnings. I think this is AT&T also reacting to earnings, up 4.6%. So what I'll do is, just to save time, because we've got a lot of different reports on earnings, and if there are no questions on the pre-market, maybe that's what I'll do, is just jump to our earnings reports. Well,
yeah, that's perfect, D. We had just a quick question from a new chameleon who popped on this morning.
Yep.
He was asking, and I know you talk to, Jesus, hundreds, thousands of people who text you and talk to you, ask questions. Do you get a sense of what brokerage accounts most people are using?
I mean, some people don't always tell me the brokers that they're using, but the ones that come up the most, I would say, are Interactive Brokers and Thinkorswim. So those come up a lot. I hear sometimes Charles Schwab, and then not as much, but sometimes I hear like Robinhood or E-Trade. But that, I would say, that's in the low single percentage that I hear. So the vast majority, I would say, is like Thinkorswim or Interactive Brokers. Those come up a lot, and sometimes people have multiple accounts too. And then there are like some other brokers that have niches. People with portfolio margin. I don't know if there are a lot of, there are probably not a lot of people using portfolio margin, because you'd have to have, a bigger account. But portfolio margin, then sometimes you'll hear like bigger banks.
Very cool. Thanks, D.
Yeah. But yeah, if I had to just say the top two, Interactive Brokers and Thinkorswim.
Excellent.
Yep. So if there are no questions on the pre-market, or if you don't have any outstanding questions, I'm going to move on to our earnings reports.
Yep, we're looking forward to it.
Okay, so I'm going to use the earnings menu, upcoming earnings. And we do have, usually you'll land on this summary report, and we have like 4 different tabs up here that you could switch in between. So in the summary report, it kind of just gives you some highlights. I'm going to use these filters up top, and these filters will control the reports below. Okay, so let's just first, I'm going to take off the average option volume filter. I'm going to just say any stocks, and I'm going to look for stocks in the last 2 weeks that reported earnings, like in the S&P 500. So I'm going to look at S&P 500 stocks only. Okay, so So we're using SPY as the components, the stocks that are members of the S&P 500. And below, we kind of get two tables. These are upcoming earnings, and we have a list of, I think, 10 stocks here that are going to report or expected to report in the next 2 weeks. We have two sides. This side over here is looking at the current implied straddle. So this is looking at if you're buying a call, buying a put at the money, you're paying a premium for those options, and the stock has to move by enough of a percentage from the current spot price to cover that premium. So it has to move either up or down, right? Because you own a call and a put, but since you bought both, you have to take into account the premium that you paid for both, and it has to move by enough of a percentage to cover the cost of that straddle if you're buying. And if it moves beyond that, that's when it becomes profitable. If you're selling, of course, you just want the stock to sit right at the spot price, so you could collect all that premium. Now, so Tesla up here, it's coming up April 26th after the market closed. That's when it's expected. The straddle's implying right now a move of 9.4%. So what we do is we compare, and this is a little bit early, right? So you really want to wait till the day before, but it's kind of just giving you a heads up what's coming and where the straddles are priced now, because you could see these are still far away from today. But here it's saying that straddle right now is pricing in a premium 9.4%, the front month straddle. Well, how does that compare to historical moves in Tesla after they reported earnings? So a quick reference we do here is 4 quarters. Okay, it just compares it to last 4 quarters. If you want to go beyond that, you could go to this full report. If you want to go even beyond that, you could go to Tesla specifically and look at, a longer history. But the first reference here we got is last 4 quarters. So if we took Tesla last 4 quarters and just what the average move was up or down, we see it was 2.8%. The high move in the last 4 quarters, 5%. The low move, 0.7. So on this side right now, on the left-hand side, this is looking at the top straddles that are above the 4-quarter benchmark, right? So the premium here is above 9.4%, above that 4-quarter average, 2.8%. So really quickly, we just kind of get a sense of how much above that benchmark, right? The difference between this and this, 6.5%. On this side, we have the top 10 straddles that are trading below their historical 4-quarter average actual moves, right? So here we have Intel. That's coming up tonight after the market closed. That straddle, as of yesterday's close, was implying a move of 5.1%. And we see here last 4 quarters, the average move in Intel, 9.1%. The high move in Intel, 16.2% after reporting earnings. Low move, 0.4%. So we see here, this kind of tells us how far away it is from the 4-quarter average, right? So you got 5.1%, historical 9.1, so about 4% below that historical benchmark. In other words, you're looking at how richly are these premiums priced relative to historical realized moves. And when you change these filters up top, all these will change. So if I just wanted to say like QQQ, so then all this data will change just for QQQ. If I wanted to look for, let's say, biotech stocks, so here are biotech stocks. So these are the biotech stocks coming up in the next 2 weeks with the straddles, top 10 straddles that are trading above their 4-quarter average realized moves, and then below their 4-quarter average realized moves. So hopefully like that makes sense, because it's just like a really quick way to look for potential ideas or candidates to research if you're trading straddles around earnings. Let me come back to the S&P 500. So I'm going to set this back to SPY, S&P 500, and let's go down to the next report. So this report here just lets us know in the last 2 weeks, what happened to, stocks that were over, so where the premiums were trading above the historical averages. Once they reported earnings, what were the outcomes? So down here, we kind of have like the top 10 here, and then top 10 on this side, where the premiums were trading below the historical average. So we could see here like ALK, the implied moves heading into earnings, 9.1%. The actual move was 1.7%. So you could see here, it did not make an outsized move. So that straddle was priced high, and the move was 1.7, so much lower than that straddle was anticipating. So it did not make an outsized move. PNR, same thing. They were implying a move of 6.2%. The actual move was 2.3%. So it did not make an outsized move. And this is what the last 4 quarters were. So you could see here, they're implying 9.1% ahead of earnings. The previous 4 quarters on average it moved 1.5%, and this moved 1.7. It's kind of like doing this. So this is going forward. This is what happened recently. Does that make sense to people? Hopefully.
Let us know if you have any questions about what Dima just said relative to the earnings and the moves. Anyone? Nothing's popped up yet, D.
Okay. And here on the other side, it also shows us, well, what about where the implied moves were heading into earnings were below the historical averages. And here we could see same thing. This was 3.2% heading into earnings. Historically, on average, moved 5.7%, but this time around, it was almost unchanged. So this one did not make an outsized move. So you could see that, how many times it made an outsized move, which is outside the implied straddle and within. So you could see here, Netflix, they were 6.5% heading into earnings. That's what the straddle was implying. Historically, 4-quarter average move was 8.3%. So what happened after they reported earnings? So on that day, which was like a day ago or yesterday, it was down 7.4%. So you could see that move exceeded what the straddle was implying heading into earnings. Okay, let's see how did the S&P 5. So I still have that filter set. These are only filtering out what I have set up here, right? So these are only looking at S&P 500 right now. So what did the stocks do in S&P 500 in the last 2 weeks that reported? So this is just looking at all the stocks that reported using that filter. And we had 49 stocks that reported earnings and were up on the day. 38 stocks reported earnings. They were down on the day. 1 reported earnings and was unchanged. So 55.7% of the last 2 weeks that reported earnings, stocks in the S&P 500, those after reporting earnings, the stocks were up on a day. So positive reaction. 43.2% so far had a negative reaction. They're down on the day. How did they tend to react on average at the open? So the stocks that were positive at the open, on average, the opening gap was 1%. The stocks that were negative, on average, down 1.3%. So here, just taking a look at the bias so far, the ones that were down on the day had maybe disappointed, whatever they said. The impact to the downside was a little bit higher than the impact to the upside, right? So far, those are the takeaways from the last 2 weeks.
We did have a question popped up when you were talking about the overvalued. Unfortunately, there's a little bit of a delay, so the questions are not in line with what you're talking about at the time. But Robert, who's on pretty much every morning from Chicago, asked, so do you create a butterfly or condor to take advantage of overpriced pricing, i.e. in these sell situations?
I mean, like really that it's up to the trader, like because you'd have to go in there and kind of start looking around at potential movements and really what else is going on in the stock, right? So it's a starting point. If they have anything going on, and we kind of say like take a look at a deeper analysis, which we do on a stock, where we go in there and take a look at, well, what did the stock do since its last reported earnings? What kind of news does it have? What kind of buildup is it doing? What are the, you'd have to start kind of like trying to picture yourself a potential distribution of returns. But his question was like, do you, an iron butterfly, what is it? Iron
He was
butterfly.
just looking at a butterfly or a condor.
Right. So if you
So
believe
something
like,
obviously to sell the meat and buy the wings for protection is what.
yeah, and you'd have to go because you're also introducing wings, so you have to go in there and see where the wings are priced. So I would, you want to go set it up on the options chain, see where the wings are set up, rerun that distribution. And if we have time, I'll try to do an example.
Perfect.
If we have time, but I'm trying to, you could see here, I'm just going through one of the reports, and I was going to try to get through all of this.
Perfect.
So, yeah. So here we kind of see that so far, at least that in the S&P 500, more stocks were reacted positively to their earnings than negatively, but the ones that were negative, at the open, had a slightly higher magnitude of a move towards the downside. But by the end of the day, we see that the stocks that had a positive reaction to earnings, so this is like a full days, not just the gap at the open, but full days, on average, they gained 2.6% versus on average, the stocks that had negative earnings were down 2.5%. So that looks to me, that the bias so far after reporting earnings is to the upside, okay, in the S&P 500. So that's in the last 2 weeks. What if we did the strat? So this is how the stocks reacted. What about the straddles? Like if we just took each straddle, right? Because buying a call, buying a put, irrelevant where the implied volatility is, we just, in every strat, we just did the same exact strategy. Doesn't matter, where the implied volatility is, what the historical average moves were. What if we just bought the straddle in each one? So what happened? And remember, some of these might not even have options, or some of them the options are too wide, we skip it. So if we did that in the last 2 weeks in the S&P 500 stocks, 22 of those 22 straddles, buying them, were profitable. Okay, 32 of those, the straddles, were not profitable from the buy side. So if you bought it, the company reported earnings, the stock didn't move enough, the straddle implied volatility came in, you lost money in this situation. In these 22, if you bought the straddle, the stock moved enough that the straddle was profitable because it was worth more the day after reporting earnings. So 40.7% of those were profitable, 59.3% they were not profitable. Okay, the ones that were profitable, what's the average gain, right? So we know you only made money on 40%, you lost on 60%, but the ones that were profitable, on average, if we took the average, the gain was 40.2%. Okay. The other, on the flip side, the ones that were unprofitable, so you had to buy them, you sold it back out the next day for a loss, on average, lost 26.9%. All right. So does that make sense to everybody?
No questions have popped up yet. I'll let you know when we get one.
Okay. So then let's go further. So that's just, straight buying straddles, no, with no bias, nothing. We just, here's an S&P 500 stock, day before buy straddle, next day sell. So what about if we did the same strategy, but if we just focused on and we separated where the implied move was greater than the historical average, right? So this guy's over here, and then we separated these guys over here. All right. So what about the straddles where the implied move was greater than the historical average? In other words, should we have avoided them, or maybe the market was telling us sometime, maybe people are doing their homework, and by actually making those straddles greater than the historical averages, they're bidding it up for a reason, right? And maybe that was an indicator that the move was going to exceed the actual straddle, right? So sometimes just because the straddles are high, they could be high for a reason. Somebody's doing their homework, somebody like figured something out, and then the moves could be the magnitude of the moves could be much greater than historical averages. So what happened? Those 14 of those, the straddles actually from the buy side were profitable. 22 of those, they were not profitable. If we looked at, so the percentages, 39% were profitable, 61% were unprofitable, which is close to, it's close to this, slightly worse. This is slightly worse than this from the buy side. On average, you gained 35% buying those on 38.9% winners, and on average, you lost 22% on those 61% of the frequencies. Okay, so that's where you're comparing this to the overall benchmark. Okay, what about if you bought just the straddles that looked like they were cheaper than historical averages? Basically, we took the benchmark 4-quarter average and we just stuck with the ones that looked like they were a good deal relative to their historical realized moves. So in this situation, buying those straddles, 44% of those were profitable versus 40, right? So this is our control group versus 40 for an average gain of 48.9%. In other words, the average gains in these exceeded the overall benchmark, and definitely higher than this. And 56% of those ended up being not profitable, right, as a loss versus 59% overall for an average loss of 35%. So here, the loss was greater than the overall, but the gains were greater as well, right? So 55.6% of the time, you ended up losing there versus 59.3 overall, right? So those are, you guys do the math and see your average returns. Okay. Any questions on this report?
No, it's the only question we had was, and it was two people actually, they were chit-chatting about the trading cards. And I don't want to take you too off topic if we want to get to it at some other time, but
okay. Well, what's the question?
Well, the question was, I have a question not related to this, but important to me since I'm new to Market Chameleon. Do you have statistical history of wins on the trade cards? And, to me, the history is the historical win rate is the history. We don't track cards. That historical win rate changes with every outcome. So it's constantly
updating. So let me go to the trade card. Let me see if I could just really quickly go to trade card and explain. I'm gonna keep this up. I'm gonna try to come back to it. But look, so here's a trade card. And a trade card it scans the markets and looks for statistical edge at the moment in time, right? So you got to think of it this way. It's not an actual, obviously we're not doing this isn't actual trades, right? This isn't, you have lots of trade cards looking at lots of different markets. It's hundreds of thousands, it's looking at millions of markets, looking at different strategies, looking at, multiple legs of these strategies have multiple legs, and these are continuously changing, right? So these are like continuously changing markets. And what it's doing is saying, well, based on, this is the market. Historically, if you did a similar, if we looked historically at a similar situation, what was on average, what was the end outcome? So for example, here in Apple, right, we have this April 30th expiration, 142 strike. So if we looked historically and said, well, in Apple, you know, if we looked at the same amount of trading days to expiration with the strike same distance away from the spot price, and we looked at what did the stock do, how did the stock behave during that period, and what on average, what was the end value of this call theoretically, right? So if it went up 10%, then we could figure out what the average, what the price of this call would be. So if it went up, if it went down, then this call would have ended up worthless, right? So we look at on average, what is the end value of that on average, that call. Same thing for all these strategies. And what was the frequency of this call being profitable? So this is looking at a historical stock behavior of the stock, right? So it's not an actual, we didn't do this trade. It's not like, you know, we're just running the statistical analysis on that option. Does that make sense?
Yeah, that's helpful.
Right. So you kind of think of it, and it's using a certain data set, right? So we're using a certain data set, and we're trying to also use a data set that comes close to what we see, or what we're currently seeing. So we're taking a look like, is Apple going to report earnings? Yes, April 28th. That's going to cover earnings. So then we're only looking at data sets of Apple moves that covered earnings and straddle the days straddled earnings the same amount. What is going on with implied volatility, where the implied volatility is low? So it's looking for implied volatility that is low historically to see what the outcomes were. So if I had to kind of compare, let's say you had to make a decision, somebody wanted to bet you and said, I think this basketball player, for example, is out of the next 10 shots, he's going to make 3 shots or less, right? But not more than 3 shots, right? So he's going to miss 7 or more, basically, is what we're saying. But he's not going to make more than 3. So then you could start looking historically. Well, okay, he's betting that he's going to make 3 shots, but historically, he's 50%. So he makes half the shots, right? So then you start building the model. Okay, so that seems like theoretical edge, because I don't know if he's going to make, you know, the next, how many he's going to make, but he might lose, he might make all 10, he might get 0, but historically his average is 50%. But then you could start building other things, and we'll say, okay, but this game, the next game is not at home, where there's an advantage, it's away, and maybe he had to travel from, you know, Philadelphia to California. What are his percentages then? Because now you're looking at a different data set, right? Oh, well, then his percentages, when he historically fell by a lot, because when you have one day to travel, you're tired, whatever, maybe then you're like at 20%. So you could see that what you're doing is just using historical benchmarks to compare to where the market is. And you're always just trying to see how far away it is from that benchmark. Does that make sense to hopefully the person asking the question?
Let us know if that makes sense there, chameleons. Seems super helpful. I hope that helps, George.
So we're right up at 9:30. Well, I guess, you know, I'll just continue tomorrow on this, because we do have, you know, I think I completed at least this first page, the summary page. We'll continue on the next pages for the earnings.
Awesome. A continuation tomorrow, everyone. Dima, great job as always. You're bringing it every morning. Every morning is like a webinar. It's awesome.
All right. Thanks, guys. Well, really appreciate you joining us in the morning. Stay safe out there. Have a great trading day, and hope to see you tomorrow.
Have a great day, chameleons. Trade and